Good afternoon, this is Mike Peterson, the Bear Market Investor with the market update for February 24, 2011. We're here looking at the S&P 500 stock index, and then we're going to be looking at the Volatility Index after that. First, let's go ahead and update you on our wave structure. As we had noted before this, we were working under the interpretation, and we still are, that we had an ABC correction from the March 2009 lows. That, we believe, may have concluded on Friday, the 18th of February. And if you'll note from the last video that I made, I was suggesting that Friday, in fact, from a cycle standpoint, would look good for a top. In fact, we did get that. I was expecting a little bit more of a sell-off and then a push to a new high, but regardless, we got that put in, and then we sold off from that point fairly steeply. And what I can tell you here is that this looks fairly impulsive to me, and we'll get into that shortly, but we're going to need further confirmation here that a longer term top has in fact been put in place. Now, from an Elliott wave standpoint, we had concluded a wave 3 of 5 of C at this level. We had completed a running flat wave 4 of 5 of C at this level, and then we're in a fifth wave push that was fairly extended. And from that standpoint, there were multiple interpretations within this push that we were looking at with regard to how to break down this wave structure. But in either case, whether you would have considered this a fourth wave low and then an extended fifth wave, or you consider this a fourth wave right here and then a still fairly extended fifth wave, in either case we have broken below that. That is good news for the bearish case. Now we have come to this line of support right here, and we have bounced off of that, and we have been waffling around within this longer term area of support and resistance, these two particular areas right here that I want to point out, that we were looking for a potential top to be made all the way back in here. And so we were bouncing around in there, then we came back down to test this area of support as well. Inevitably, I think that will probably end up breaking. We have a broadening top formation in play here with a first, second, third, fourth, and then fifth push up here. And we're starting to break down from that. Now, ideally, what we need to see is for this broadening formation to play out and see this continue to break down here. Now, there is a possibility of some upside here because I'll show you this in greater detail in a moment, but this looks like a complete 5-wave push, suggesting that we are going to experience a counter trend bounce here that will probably lead us somewhere in that 1325 to 1332 area, somewhere in there, before going ahead and moving lower. So that's, at least from a short-term perspective, what we're expecting here. It doesn't necessarily have to happen, but it certainly looks good from an hourly chart standpoint as well as other time frames as well. We could see a little bit of selling perhaps in the morning followed by that rally, but we'll wait and see what happens here on Friday and hopefully give you a better picture of that short-term wave structure on Friday or over the weekend. So in any case, we have at least a good possibility that we did top here. However, we have not yet broken below this fourth wave low, and that ideally we need to see happen right here in order to begin to confirm a longer term reversal has in fact taken place. Now from there, we need to go and break the last major low that was made from the the sell-off that we had from the April 2010 peak into those lows. So we need to go back and challenge that mid and lower 1,000 area on the S&P and break through that eventually to move on lower, confirming that in fact a long-term reversal has taken place. So those are the scenarios here that we need to see play out, or the things we need to see play out in order to confirm that in fact a long-term reversal has taken place, and that we're not just going to continue to subdivide or alter our wave structure into something else. So this is very clean wave structure right here. I have no issues with this wave structure. I have seen some other wave structures out there that are unnecessarily complex, and there are a number of wave analysts, and I think they're brilliant and bright people that have some extremely unique wave counts here in the S&P and on other indexes, but they're unnecessarily complex. An ABC correction here is the best way of looking at this at the moment. It doesn't mean it's the right way or that their wave counts won't turn out to be correct. However, it does look to be the best. The simplest way of explaining something is oftentimes the best way of explaining, and that's what we're going to go with for right now. So in any case, we did find support here. Well, let's go ahead and jump into the shorter term charts and show you what's going on. Now we're looking at the 5-minute chart of the S&P 500 stock index. I want to draw your attention all the way back to last Friday, February 18, 2011, where we believe, under the current Elliott wave interpretation, and I believe the best and the simplest, that we had completed an ABC correction from the March 2009 lows, and that we are changing the trend from up to down, resuming the larger bear market. Now, what I can show you here is it does look like we have a fairly complete 5-way push to the downside. I don't know that to be the case, though, yet, because we have not yet broken above this last minor high. However, this is probably the best way that I would count this as of right now. We have a first wave down, second wave up, third wave down, fourth wave up, and then a fifth wave down. There is also a possibility that you could say this is the end of the first wave down, that this is the second wave up, that we had the third wave down conclude here, the fourth wave up, and then the fifth wave down. No matter how you slice and dice it, it does look to be 5 waves. But again, as I noted, we have not yet broken above this last minor high. I do expect that to happen under a second wave. So this would have been the bottom of wave 1. We would be working on wave 2 right now. But looking at this pattern right here, this looks like an ABC correction. And having it end below this, if it has in fact done so, is kind of odd if this were a 5-way push to the downside, because that would be extremely weak second wave, and it just doesn't make any sense. I would expect that to at least retrace, a good portion of the prior first wave decline. Under the interpretation that this is in process of carving out a second wave, we would want to see this probably end somewhere between the 1325 area, mid 1320s, to the low to mid 1330s. If we start seeing it go beyond that, then we want to start questioning this entire decline right here. Now, as I had noted, there are implications to this playing out that way, where we actually do exceed this peak. But there are explanations for it as well, if that happens to be the case. It's just not the probable outcome here, and that's what I want to that's what I want to say here. So if people are really looking for an opportunity to get short, if it were me and I was trying to play it safe, what I'd probably be waiting for is a pullback here, and then a convincing thrust to the downside that will eventually break this low right here, as well as that fourth of fifth of C wave. Once we see that, it's likely we're continuing on to lower levels. But at any point in time, you are going to see pullbacks, and oftentimes from a trading standpoint, pullbacks in either direction of trend are the best time to buy, or sell short, however you want to do it, and to maximize your profits. But now that said, again, we don't have anything but a short-term reversal that is yet confirmed, and so that's what I'm trying to get across here. Now, real quick before we switch over to the volatility index, I want to discuss a couple things. First, very recently, as a wave 4 of 5 of C, we were tricked by the market into believing that the trend had changed from up to down. That is because a running flat like we had in wave 4 of 5 of C, and you can review my prior videos for more information on that particular wave structure. We had 3 waves down, 3 waves up, and then 5 waves down. That 5 waves down tricked us because it made us believe that we probably had changed from up to down. Now, I don't think that's the case here, but I wanted to bring it up because those types of things can happen. You can see 5 waves down and then still see the market exceed its prior peak, and it's usually because of some complex corrective pattern taking place. And so whatever happens, we don't want to see that prior peak taken out, and then we want to proceed on in the bigger picture to put 5 waves down in as well. So we want to see a second wave put in, followed by a third wave that takes out this, as well as that last 4th wave low, which was wave 4 of 5 of C, that running flat. We want to see that taken out. We want to see major areas of support taken out. We want to complete a 4th wave then, and then we want to complete a 5th wave. And that's really going to help seal the deal for us, okay? Once we start seeing that type of price action, that does suggest that the trend has really changed from up to down. And from there, we would see a second wave up that would retrace a portion of the larger first wave down, and then we would see a third wave down, and so on and so forth. Now, big picture, somebody had asked me, what is my big picture count for the S&P 500? I'm a little bit undecided there, and here's what I mean. Back in the early 2000s, when we put a peak in the S&P 500, and of course had a subsequent sell-off in the S&P 500, there is a legitimate count that has us putting a third wave top at that point, followed by an expanded flat correction that we had an A wave putting in that low, and then a B wave into the 2007 highs, and then we're working a larger C wave, which would consist of a 5 wave push down from the March 2007 from the 2007 peak. Now, the other option being that we put in a grand supercycle wave 3 at the 2007 peak, and that we're in an ABC correction, with the A wave likely being the March 2009 lows, the B wave being last Friday potentially, and that we're now working on a C wave. Okay, but there is one other possibility. In either of the two cases that I just laid out to you, we would be in a large grand supercycle wave 4. That means that it also could be a triangle. In the case of a triangle, we could have already seen a low in the March 2009 lows, and that we're going to be essentially moving net sideways for years to come. That doesn't mean that we're not going to experience a strong sell-off, however, but it does, under that particular scenario, mean that we would not go below those March 2009 lows, and that we would, on a subsequent thrust to the upside, fall short of the peak that we just put in here, followed by another decline which falls short of that last low, and then probably on to highs in a grand supercycle wave 5. Now, that would have us, of course, moving sideways for years. I don't think that's the most probable outcome. I think either of the two first scenarios that I just laid out, either that we're in a large expanded flat grand supercycle wave 4, or that we're in an ABC correction in a grand supercycle wave 4. I think those are the most two probable outcomes here. Now let's go ahead and take a look at the volatility index. Now we're looking at the weekly time frame of the volatility index, and what I want to point out for you, if you have not seen this, is just what all these trend lines that I have on this are for and what they mean. Now, with this particular trend line right here, we're obviously connecting that 2008 panic with the panic that we had in April 2010, and to create this longer term wedge pattern right here, this declining area of resistance, we have a horizontal level, which is more of an eyeball thing, but more particularly from recent levels right there. Then we have this ascending area of support longer term, connecting these couple bottoms that we had right there. We have this fairly substantial horizontal level of support that we've not really convincingly broken below, other than just on the intraday. And from there, as you can see, just in the weekly time frame, we've broken out, and this is what we're expecting, but we have not broken out from the bigger picture. Okay, this blue thing right here I'm going to describe in just a second. Let's go ahead and jump in the daily time frame. These blue lines right here represent the Fibonacci fan. Not a lot of technical analysts know how to use this and under what circumstances, but I'm showing you that right here. This is probably not a chart you're going to see with any other technical analyst. At least I haven't seen it anywhere. But let me show you how this works. We had an initial breakout of this little wedge pattern right here, and that is what I drew with the Fibonacci fan. From there, we have the 38.2% retracement, the 61.8% retracement, and then the 78.6% retracement on the Fibonacci fan. Now look where that 78.6% retracement happens to fall. It falls and coincides with exactly the longer term declining area of resistance there on the volatility index. And that is a very interesting thing, and I think it is of no coincidence whatsoever. This is the type of thing the market does. This is the way that the market works and how psychology drives the market. Okay? And you can see that horizontal level of support right there. Now, just looking at the last few days here, this is a pretty bullish breakout that we have. We've come up near to test that 24 level. Haven't quite gotten there yet, but again, we may see a little bit of weakness tomorrow before proceeding on higher. But ultimately, we're going to find resistance here at the 78.6% retracement on the Fibonacci fan, as well as that declining area of resistance. Once we see that breakout, then we have the real potential for the market to crash. Until we see that breakout, there is a possibility that the market may move higher in the end, or may just hold up until the middle of the year. Okay? And what we can see here is, as long as this horizontal level of support holds, you know, this wedge pattern or this declining area of resistance would allow us to hold up through June or July, and or even make a higher peak in the stock market, you know, possibly altering the wave structure that we have as best case at the moment in the S&P 500. Okay, so volatility index is very important to keep in mind, you know, to allow you to put the S&P 500 into proper context. So while there is a, you know, real possibility that the 78.6% retracement is of no significant value, I think it is going to be of some value to us, because it directly coincides with that longer term declining area of resistance in the volatility index, and will present some significant resistance and a significant hurdle to the volatility index really breaking out to the upside before bouncing off of that. Or maybe we even do get a breakout and then we backtest and then move on higher. We just have to wait and see how this thing plays out, and the market's just going to tell us that when the market's ready. But volatility index, very important thing. Do not believe people that tell you that it is of no significance whatsoever. I hear Kramer say that all the time. He says the volatility index is useless. Don't believe him, and I'm showing you right here. This is very, very interesting. We see how those 38.2% retracement levels and the 61.8% retracement levels have played out, and how we've seen back tests of those, and attempts at breakouts and failures and this and that and the other thing. I mean, this is the type of thing that we're seeing here on the Fibonacci fan, and why this is important. More to come on this weekend. I hope you have a great night. Please rate the video if you would. Appreciate it. Thanks.